Hey everyone, coming into 2024, I recommended Visa as my top dividend stock to buy. But is it still my top dividend stock to buy? Visa recently reported earnings results that shed a lot of light on the rest of its 2024 prospects and how it's going so far this year. So I'm going to update my recommendation for Visa stock. So stay tuned and let's take a look at the latest numbers. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, like I mentioned, I had Visa rated as my top dividend stock to buy. It's also on my list of top 25 stocks to buy. And I last updated my Visa stock recommendation on March 31st. So I'm going to do so again today. You're going to want to tune in. Let's see what's happening at Visa. So the company reported earnings growth of 12% up to $2.29 per share on revenue growth of 10% to $8.8 billion. That's solid growth for a company the size of Visa. Overall, they said payments volume grew 8% and cross-border volume grew 16%, driven by stable consumer spending. And that's been the story so far in 2024 is consumer spending has been robust. We got revised GDP numbers for the first quarter of 2024 that came in at 1.6%, a little bit lower than initially expected, still higher than what I expected to begin the year, where I was expecting GDP growth of between 1 and 1.25%. All of the macroeconomic numbers coming in are stronger than I thought for the year. People are spending more money. People are finding jobs relatively easily in the US. People are not getting laid off at the rate that I thought would be happening at this point in the economic cycle. And this is all with interest rates above 5%. So I've been surprised at how well the economy is performing. And Visa, of course, benefits the better economy performs. Now, it's also not going to do very poorly when the economy does very poorly. It's not a cyclical business, although it would prefer that people make more money, work more, and spend more. All of that means you're using your Visa card more often and you're spending more when you use your Visa card, all of which benefits Visa. Another trend that's benefiting Visa is people are traveling more. Remember 2020, 2021, 2022, people put off a lot of their travel plans, and more often than not, when people travel, they use their Visa cards more than if they weren't traveling. So that's been a boom, as they noted. Cross-border volume transactions up, cross-border volume up 16% year over year. So that's been a benefit to the business as well. Some other notable items that happened in their latest quarter. On March 26th, Visa announced it agreed to a landmark settlement with U.S. merchants, more than 90% of which are small businesses, lowering the credit interchange rates and capping those rates into 2030. The interchange multi-district litigation injunctive relief case settlement also provides updates to several key network rules, giving merchants more choice in how they accept digital payments. So, in other words, to put this in simpler terms, Visa and MasterCard were accused of anti-competitive practices. And I've been talking about that a lot with Visa and MasterCard. They don't compete fiercely against each other. And merchants are complaining about that. They would prefer that Visa and MasterCard compete fiercely, trying to capture more business, selling merchants on their own service by offering them incentives and promotions to try and get them to accept their card instead of MasterCard. But that hasn't been the case. Visa and MasterCard have been playing nice with each other, which is really good news for investors. I've been talking about that for a long time. When the two dominant players in an industry, or three dominant, or however many dominant players in an industry, are not competing fiercely against each other, that's great news for investors because that keeps profits elevated. It's the opposite of what's happening in the electric vehicle industry. They are competing fiercely against each other, lowering prices, increasing advertising, increasing supply, all of which is hurting profit margins. And you're seeing that across the board. Every company that produces and sells electric vehicles is not doing as well as they were 2 years ago or 1 year ago. all because of the increasing competition in that industry. Competition is very, very bad for investors. Increasing competition is very, very bad for investors. It's actually, when I saw this news, it really cemented the point home that Visa and MasterCard have such strong competitive advantages that they're getting sued and they're getting complaints from merchants. They're actually on the borderline of being like too anti-competitive, as this landmark case suggests. But as an investor, you would rather be on that side of the equation where the businesses you own are being accused of being too anti-competitive or being accused of potentially running a monopoly. And while that might not be good for consumers, it's great for investors. So that's the dilemma. If you're kind of squeamish about companies that are too dominant, like Visa, MasterCard, Microsoft, Alphabet with Google, these are very, very dominant companies. It's not good for consumers because they drive up prices and they have pricing power. But it's great if you're on the investor side of the equation. And it's not surprising that many of those companies that I mentioned are on my lists of top stocks to buy, because that dominant market share, that dominant position in the market allows for excellent returns on investment. Now, going on, they said that during the 3 months ended March 31st, they repurchased 9.7 million shares of common stock at an average price of $280 per share. So Visa spent $2.7 billion buying back its stock, signaling that it feels its shares are undervalued. Now, you don't hear Visa CEO going out and making boastful comments about how he feels or she feels or whatever the management team feels about the share price. They just go out and quietly purchase nearly $3 billion of their shares. That's the strongest signal they can send to tell investors that they feel their shares are undervalued. Other companies and other CEOs, instead of buying back their stock, they might go out and complain about how their stock is undervalued, how short sellers are shorting their stock, and how it's not fair that short sellers are allowed to sell their stock. Well, they could just go out and buy it if they feel it's undervalued. Just go out and buy it. And that solves your issue, right? You think it's undervalued, so go and buy it. You have the choice to go out and buy your shares back. That's what the company is doing. And I try to say in my videos to highlight that difference between companies that complain about their shares being undervalued and complain about short sellers versus companies like Visa that just go out and quietly spend billions of dollars buying back their stock when they feel it's undervalued. As an investor, you want to gravitate towards these types of companies that quietly purchase back their shares and run away from companies that are complaining about short sellers and how it's unfair that they can short the stock and all of this other talking instead of going out, taking action and buying. That's the real signal that you feel your shares are undervalued. Another thing I really love about Visa is that there are now 4.4 billion Visa cards in people's wallets today or on people's phones. That's up 6% year over year. The same quarter last year, they had 4.2 billion Visa cards outstanding. This is remarkable to achieve this kind of scale, 4.4 billion. This is more than how many people use Meta Platforms apps on a daily basis. That's the sheer scale of this network, right? And this 4.4 billion cards outstanding is what makes businesses almost have to accept Visa at their location. If they don't accept Visa, they're missing out on potentially 4.4 billion customers. If these customers don't have an alternate payment method, if they're only using Visa and they don't have another credit card or another debit card, then they're missing out. They have to accept Visa and they have to pay that fee. Every time someone uses a Visa card, it's something like 3% plus some small amount. And every time someone uses that card, Visa gets revenue. It's a great business model. It's an asset-light business model. The difficulty in this business is building it. Once you build it, it's incredible. And that's why Visa has been one of my top stocks to buy for a very long time. Now, in addition to these recent developments, Visa's operating profit margin 67.1%. Although it dipped recently, it's the highest of any company that I follow. There is no company that generates these levels of profit margins that I know of. Maybe you know of one that's more profitable. I haven't found one. So that business model is what allows Visa to generate these types of profitability, and the competitive dynamics in the industry help it significantly. Now, Visa is still trading at a relatively fair valuation, a forward PE of 24.67. It's not cheap, but it's also not expensive. Given how excellent the business is, I don't mind paying a fair value for an excellent business, which Visa is. It's in the Hall of Fame of excellent businesses in terms of performance. So to reiterate my recommendation, I'm going to keep Visa as my top dividend stock to buy and keep it on my list of top 25 stocks to buy in 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.